Hey everyone, how are you this afternoon? Hope your day has been fantastic so far and that you haven't stayed too hot if you're in a part of the country that actually gets hot. Those of you who are in San Diego, I don't want to hear it. Although you're getting battered by storms right now, but the heat, come on. So I'm in Texarkana, Texas. And by the way, in the comments, I'd love to hear where you guys are from, as well as to make sure that my audio and video is working fine. We never know exactly what's being sent out there across the streaming servers. So hopefully everything is working fine. But in the comments, let me know real quick, just a city and state where you're going, where you're listening to this from. So it sounds like my audio and video is working because someone just said Kansas, Chicago. Fantastic. So right now we have 212 people here. That's a good number. Another Illinois, Gulf Breeze, Florida. I had to get registered in Florida the other day because we finally got enough clients there where the Florida State Securities Board mandated it. Kirk said audio video is great. Port Arthur, Texas. That's interesting. I used to live right by Port Arthur in a little city called Nederland, and we would go to Port Arthur quite often. Honolulu. I hope I can come to Honolulu this summer. That's what we're planning to do anyway. San Francisco, Tucson, New York, upstate New York. Nice. Heard it's beautiful there. Another place I've never been able to visit. In Plano, just right down in my neck of the woods. Wichita, Kansas, New Jersey, Tulsa, Oklahoma. Nice growing place there. Tuscaloosa, Alabama. And hi, Jesse. I just noticed that was you. I'm glad you could join us tonight. Another Honolulu, Idaho, Pennsylvania. Well, very good. Well, it sounds like my audio and my video is working. So let's not waste any more of your time. I know that wherever you are, if you're on Eastern time, it's 7:30 now. If you're on Pacific time, it's only 4:30, so your evening is just getting started. But I don't want to take too much more of your time. I want to jump right into this. And last time we did the webinar, we had some serious bandwidth issues, and I wasn't able to be on the screen at all. And that's okay. Most of the people came for the content of what I was talking about and not to see my face anyway. But this time, I'm going to be able to move back and forth some as needed. But it will mostly be content and information that's on the screen because I really want you to be able to focus in on what we're trying to learn here tonight. Now, set some time aside. I'm going to be here for a little while, and I hope you're able to join me for the entirety of this because we're going to talk about some really important stuff and then go over how we can get it all tied together. So with that, let me see if I can get my technology to work right, and we're going to jump right into this. All right, so here we go. Let's get moving. And I'm going to sure I'm good here. My audio and video should still be working. That is the case. So let's jump into this. Retiring is not quite as simple as it seems like it should be. You see all these brochures that these big brokerage firms publish, and they talk about, you can see that there's these stock images. There's the happy couples on the beach, and sometimes there's a lighthouse in the distance with sailboats going by. And that's the illusion of retirement that nearly everyone has. And then when you get close, you find out that before you get to do any of that fun stuff, there's actually a lot of choices that you have to make. The truth is, some of these choices are pretty complicated. When do you file for Social Security? What's the right order to draw money from your retirement savings? And should you think about Roth conversions, and how do you model out those taxes? Some people just wing it and they hope for the best, but those who really care about their retirement plan generally reach out to someone or some piece of software for help. And even that doesn't always go well because in a lot of cases, it seems like that help is always tied to buying a product. Give me an amen in the comments if you know what I'm talking about here. It may be an annuity or life insurance policy, or it could be that a big firm just uses this software to create a retirement plan that may have some good information in it, but it's buried in 80 pages of charts and graphs and those dang pictures of happy retirees walking down the beach. But it's really just a lead in for their services. It does seem like everyone has a product to sell. And let me tell you, a properly constructed plan for retirement will have to include some assumptions about rates of return, but it should never include products. And if a product is the backbone of your plan, watch out. Probably encountered a salesperson instead of a planner. And it doesn't matter what initials they have behind their names. The old way of the industry die hard. The financial services industry is changing, but it's always been focused on product sales. There's production quotas, free trips, and other perks that still exist, and it's based almost always exclusively on sales. So you have to be very careful when you're getting help. So today, I want to arm you with enough information to help you feel confident in your ability to navigate these waters and make good choices about retirement. So if you'll give me the next several minutes of your time, I want to walk you through a few things that you may not have thought of before, and be sure to stick with me all the way to the end, because I'm going to show you how to pull all of this together and put it into one cohesive plan. The decisions about your retirement are not easy. We've already said that, and you may hear me say that again. And by the time we finish with this, you may even be a believer. And they're certainly not decisions that you can take lightly. But unfortunately, there is a lot of one-size-fits-all retirement advice out there. Sometimes I think the retirement planning process has been boiled down to bullet points that will fit into the next 1,000-word article in U.S. News or Investopedia. One thing is for sure, though, you don't want to follow the herd and make retirement planning mistakes that may have been a good fit for someone else, but could be incredibly expensive mistakes for you. These retirement planning decisions that's either ahead of you very shortly, or maybe you have a little longer, or maybe you're already in retirement, just know that these decisions are highly personal, and they have to be made while considering the whole picture. So if you care about your retirement, and I know you do, or you wouldn't have given me an hour or so of your time in the evening when you would probably rather be watching Suits or something on Netflix. So I know you care about it. And so these decisions have to be made with careful thoughts and analysis. And my goal in this workshop is to empower you to maybe see some angles that you've never seen before and leave this workshop with certainty that you know how to make the best decisions for your retirement. So some of you may have never met me. This was on Facebook. And so some of you may have just browsed across the ad and saw it there. So if you don't know me, I'm a full-time financial planner, and I'm completely obsessed with retirement planning and then sharing what I've learned with others. You may have come to me through the YouTube channel, or you may have found me on the podcast, Big Picture Retirement, or it could be that you found me in one of the publications that I've been so fortunate to share my thoughts in about retirement planning. But however you found me, I'm really, really, really glad that you're here. So we have a lot to cover. Now, I know cell phones are a big distraction, and I can't come to your house and take it out of your hand. So just put it on vibrate. Do this for the future of your retirement. Go ahead and close the door if you're in a spot where you can. And then if you have a dog, those dogs are always notorious for interrupting us right when we need to get something important done. So step away for a minute, feed the dog, make sure it has water, whatever it is that's going to interrupt you. I want you to be able to remain focused. And if you are, you're going to walk away from this workshop feeling that your time was well spent. So let's get right into it. And first, I want to remind you of who this workshop is for. If you want to make sure that your retirement income doesn't cost you more than it should in taxes, you're in the right place. Or maybe you just want to make sure that your withdrawal strategy isn't going to put you at risk of running out of money, which is still the number one fear of most retirees. Or maybe you're just looking for a way to coordinate the right withdrawal strategy with the right age to file for Social Security, all while trying to figure out how Roth conversions fit into that picture. It doesn't matter what your reasons are for being here today. I think this is going to be one of the best things you've done for your retirement, and it's going to leave you with some knowledge that's going to lead to better decisions. Laying out an action plan for your retirement income is a lot like taking a road trip. That's why we call it the retirement roadmap. There's usually more than one way to get somewhere, but how do you choose the best way? Now, Google Maps, Apple Maps, they're pretty efficient at choosing the right way for us, but not always, especially if there's something extra that we want to see or special that we want to do. When it comes to retirement planning and we're trying to plan out this road trip, there are really two key factors that we have to keep in mind: tax efficiency and portfolio longevity. So how can you pay the least amount in taxes and make your money last the longest? So choosing the right path that can accomplish both of these goals typically comes down to getting good data and making good decisions about three key areas. The first is choosing the right sequence to withdraw your retirement savings. For example, if you have an IRA, a joint account, and maybe a Roth IRA, how do you determine which one you should pull from first, or should you pull from all of them at the same time? Well, let me tell you, it is a little more complex than just a simple rule of thumb approach, and we're going to dive into that. The second point is determining if Roth conversion should be part of your plan. In the right circumstances, this can make a massive difference in the taxes you pay throughout your retirement and how long your money is going to last. So before you get too far into retirement, you need to weigh out the benefits and the cost of doing a Roth conversion. And the last point is choosing the right age to file for Social Security. Let me assure you that this is not a decision that could be made in isolation. The software programs that promise to maximize your benefit payments simply aren't capable of looking at all the pieces that have to be examined to make good decisions. And because of the way that complex program is structured, there's no way to make a good decision about Social Security without considering how it fits in with the bigger picture of all of your assets and income together. Now, we're going to cover all three of those areas in this workshop, but let me first show you what difference just a little planning can make. This is the story of two retirees who just happened to have an identical set of circumstances. In each case, it was a married couple who wanted to retire at 63. They have $750,000 in their pre-tax IRA, $100,000 in a Roth, and $300,000 in a joint brokerage account. Now, let me tell you, we have done a lot of retirement plans at this point, and I can't tell you how typical that scenario right there is. In addition, $3,000 spouse one at their full retirement age, and spouse two, $1,700. And then for their net spending, they wanted about $7,000 per month. Now, that's after taxes, so net spendable dollars in their bank account every month. And we're also going to assume that their investment mixture and their corresponding annual returns are identical as well. So these two couples have an identical set of circumstances, except for the choices they made about how to create that $7,000 in monthly net income. And as a result, the outcomes they experienced were completely different. The first couple decided to follow the conventional wisdom approach. This is the advice that you can find in just about any of the financial publications, and it's repeated, unfortunately, by many financial planners. They simply delayed Social Security as long as possible and started taking distributions from their joint account first and then their IRA. So let's look at how this approach affected their account balances first, and then we'll move on to taxes. You can see how the balance dipped in those early years from using that conventional wisdom approach of simply delaying Social Security as long as possible and then taking from their joint account, then their IRA, and to the extent that it was necessary, then their Roth IRA. You see the account balance dipping, and that's because they're drawing all their money from their investments. So that's to be expected. But the second couple took a different approach. Instead, they used a more optimized distribution that had more moving pieces for sure, but I think it was worth it. And keep in mind, both of these couples had identical assets and they were receiving the identical amount of net retirement income. And you can see a vast difference in the account balances. And I'm going to pause here for a moment. If we see that account balance dipping down early on, I often tell people that, number one, I don't think there's a one-size-fits-all approach to when you should file for Social Security. It doesn't disappoint me when someone says they're filing early, nor does it disappoint me when someone says they are filing at 70. I think that it's a very personal decision that everyone has to make. And it really does all come down to their individual account balances, how they feel about taxes, how they feel about the future of taxes, and a number of other things. But I can tell you that for this couple with their asset mix, if you look at the blue line here, all right, I was making sure my cursor's showing up, and it is. Because they're not getting any help from Social Security in those early years, you can see how that balance dips. Now, I think I get into this later when I talk about rates of return, but we do have to understand how we are modeling out return assumptions here. These are straight line return assumptions. It's the only way that we can really look at cash flow. Otherwise, we're just guessing, right? I mean, we can throw in variable returns, but that's a wild guess at best. And so instead, we take what's been the average annual return and we discount that heavily to assume that we can achieve that on a linear or straight line basis. So for the couple that spent down their portfolio at first, if this scenario didn't work out just like we've illustrated, let's say instead of a straight line return, we had another negative year, and now this balance is down even further. So what I often tell people is that there's not a one-size-fits-all approach. There's not a best age, I just made air quotes on my side of the screen, to file for Social Security. However, I do caution people against the rule of thumb approach of just delaying as long as you can. Because when you do that, you are making the decision to maximize Social Security, yes, but at the expense, potentially, of minimizing your account savings. So you've got to have the data to understand how one affects the other. All right, moving on and off of my soapbox now. So if we take this and look at taxes, if we go back to that conventional wisdom approach, that couple that didn't file for Social Security until later and took all of their money out of their joint account, you can see this blue line. This is the cumulative amount of taxes they were going to pay, and federal taxes, by the way. We're not accounting for state income taxes here, but in federal taxes, you could see where that was pretty flat. They didn't pay any taxes at all. And then by the time they were 66, the taxes started to pick up and they continued to go up. And, by the time they were here close to the end of retirement, it was getting close to $300,000. Now, for the couple who planned this out and said, you know what, I want to be more strategic about it, let's look at how their scenario went. At first, they certainly had higher taxes. And so if this couple was ever together at a cocktail party talking about how much in taxes they had to pay, well, in those first few years, the couple that had, a better plan, in my opinion, would have paid higher taxes. But that would have been all part of the grand design. Because by the time they were 74, they were just about finished paying taxes. And by the end of the plan, the difference in tax cost was more than $150,000. And again, remember, they each had identical assets and identical net income. So the point of this story is not that you can duplicate this exactly. It's just that you have to be intentional about how you plan your retirement income because it can make a big difference. Now, before we move on, let me just warn you, there's really no way that we have time to get into all the details here. We would be here for days, literally days. I don't think any of you want to spend your night with me droning on in the mic. So, I want to cover these as briefly as possible. I want to get your attention and I want you to realize how big of a difference this can make. But, before we really get to any of the real strategy here, there is one thing that you have to do first. You have to know your numbers. That dreaded B word, right? Budget. There's one piece of retirement planning that really no one else can do for you. And it's the foundation, it's the cornerstone of your retirement plan. And let me tell you, if you screw this up, it can throw everything else off. It's your retirement budget, and having a good handle on your after-tax monthly income needs is critical to help you optimize your retirement income. Decisions on Social Security, pensions, and even the right sequence to withdraw from your savings all hinge on one thing: your monthly net income goal. So if you've struggled with this, or if you already have a budget and you just want to take a second look, my team has built a calculator that's very simple to use. And best part, it's completely free. We don't even get the submissions on this. You just use it and get the results, and that's all there is to it. You just input your expenses, and it's automatically going to calculate the total on the bottom. And again, you're not going to have to sign in or anything like that. It's just a gift from us to you, and hopefully it'll help you have a more successful retirement. Now, you can find that at caroladvisory.com/retirement-budget. I know that's a long website, so I'm going to leave that up on the screen for just a moment. But if you don't get it, don't fear. I'm actually going to email that link out after the workshop, so you'll have it, and you can just use it to your heart's content to work through there and get your numbers. It's not perfect, I'll tell you that, and it's not a beautiful piece of software either. It's not exactly crude, but it is fairly rudimentary. So it will give you the results you need, though. So just use it to your heart's content. All right, here we go. Now, once you have your number, that monthly net income number, it's time to start building a plan for traveling this road in retirement. So the first piece of this is choosing the right sequence to withdraw your retirement savings. This can make a massive amount of difference in the taxes you pay and in how long your money lasts. So I want to show you maybe an alternate way to think about taking withdrawals that very few people are talking about. For example, let's say that you have an IRA, a joint account. We call those taxable accounts around here, but I understand that phrasing is a little confusing. But a taxable account is one that you receive a 1099 on every year, that you have to pay the taxes on the dividends and the capital gains. So a joint account, a trust account, maybe it's a single account, but it's not an IRA, not a Roth. So a taxable account, and then let's say that you have a Roth, right? You have all three of the savings buckets. So how do you decide which one do you take from first? Now, I can tell you that there is the accepted conventional wisdom, and that is that the best way to withdraw is to first take from your taxable, right here in the center, and then from your tax-deferred account, and lastly, your tax-free accounts. And I'm going to tell you, this is backed up by hundreds of articles with quotes by financial planners and tax advisors. Now, part of this, I think, is really so many people in my industry just use software to do this planning, and many of them don't understand the inputs or the outputs. And frankly, I think part of the reason is some of them just aren't curious enough to wonder if this is actually correct. So they just accept the output that software gives them. I almost went into a story right here, but I'm not. It's a long story and it is pertinent, but I'll save that for another day. All right. So let me show you a screenshot. And this is from one of the largest financial planning software providers in my industry. For the withdrawal sequence, when you're setting up a plan, you can choose the option of pro rata, which means take a little bit from each account. what even they call the standard sequence, which is what we were just talking about, the taxable, tax deferred, then tax free. And then it lists some other strategies, which are rarely that useful. And those are all the strategies that are available. So you have to choose from one of those. And that's the way it's going to model your income coming out, whether that's actually the best or not. But what if I told you that none of those options are typically the most optimal sequence? They are sometimes, but sometimes they are not. Let's go back to the example that we started this workshop with. This is a couple who plans to retire at 63 and 750,000 in their IRA, 100,000 in their Roth, 300,000 in their joint account, $3,000 full retirement age benefit for one spouse, had $1,700 for the other, and they wanted $7,000 per month in net spendable income. Now, I don't want it to get too complicated and talk about layering in Social Security filing strategies yet, and that does make a very real difference. So for this, we're just going to talk about how to take withdrawals from the account. So I'm just going to make the assumption in this scenario that they both follow the popular advice that you see everywhere, and they delay filing for benefits until they are both 70. All right. So we want to talk about the conventional wisdom approach and take from their taxable account until it's empty, and then their tax deferred account. And then we'll look at an optimized approach that is slightly more complicated, but it has big results. Instead of just taking from one bucket until it's empty and then moving to the next bucket, we're going to solve for an average tax rate. Now, in this scenario, and this is different depending on the individual mix of investments and income, but we're going to create enough taxable income to fill up to 12% in the average tax rate. Now, this is not the 12% marginal rate or the 12% tax bracket. This is where your average or effective tax be 12%. This means that you take out the income you need, and if there's still room to do Roth conversions to get you up to that 12% tax bracket, you do. So here's how this will work out for this couple. First, let's look at the after-tax account balance difference between these two strategies. Again, they're delaying Social Security until 70, and you can see that pretty drastically right there at the beginning, how the values of their balances drop. That blue line is the conventional wisdom approach, though, and the green line is the optimized approach. So it becomes immediately obvious when you're looking at a chart like this that the optimized approach never gives you a balance that dips down as far. Now, there's obviously still some improvements we can make to this plan, like a better Social Security strategy and a few other little things. But this alone shows you how one little thing can make a big difference. But this is where it gets kind of good. Look at the taxes. First, we'll look at the conventional wisdom approach, and you can see that in the first few years, they paid no taxes at all. And I saw a question that popped up in the comments where someone asked me, why aren't they paying taxes in the first few years? And that's because they're getting all of their income from the taxable account, which has some gains, but those gains are still well below the capital gains threshold, and thus they have no taxes. So, and that's another one of the assumptions that we have to put into the plan is that, based on having $300,000 in a taxable account, how much of that is capital gains? I just made the assumption for these illustrations that their cost basis was about $150,000. So once that taxable account's empty, they have to move on and start taking distributions from their IRA. And then they have Social Security coming in, and they start to see their taxes increase. And over the course of their retirement, they'd pay just over $300,000 in taxes. Again, that's federal taxes only, not state taxes. Now, let's look at the other approach. Because you're creating taxable income where it could have been avoided completely, at first, this doesn't look as good, right? Who wants to pay taxes when you don't have to pay taxes? But again, like the first example we used, in this case, around age 73, those taxes start leveling out. And by the end of the plan, there is a massive difference in the cumulative tax cost. And again, keep in mind that both of these plans are based on an identical amount of spendable income, but in the conventional wisdom approach, you're paying more than twice as much in taxes. And that takes us to the second part, and that is, should Roth conversions be part of your plan? This is something that I get asked all the time about, and I can understand why too. After a lifetime of paying taxes, it would certainly be nice to strategically avoid some of those in retirement if you can. And so this is something that we look at in every retirement plan we do. And from my experience, there are cases where a Roth conversion makes sense and cases where it doesn't make any sense. After looking at what's now probably hundreds of Roth conversion plans, I've noticed that there are generally 3 reasons a Roth conversion could make sense. And I want to briefly cover each of those 3 reasons. And we're going to start with the most obvious reason and then move on to the other 2 reasons. And those are somewhat interesting because that's where, a Roth conversion could still make sense, even if the numbers may indicate that mathematically it doesn't make sense. So to make sure we're all on the same page here, let's talk about the basics of a Roth conversion. This is where you take money that you had saved on a pre-tax basis, like a traditional IRA or 401k, and you transfer it to a Roth IRA. Now, the benefit of doing this is that a Roth IRA grows tax-free, and withdrawals in retirement are also tax-free as long as you've met the holding period. Now, the downside is that when you do a Roth conversion, you pay income taxes on the amount that you're converting at your current tax rate. So, and let me make a quick note too on Roth conversions before we move on. If you're going to move money from your pre-tax account to your Roth account, it generally makes the most sense when you have a decent balance saved in a taxable account like a brokerage account or a savings account. That's because it's most efficient when you can pay the taxes on a Roth conversion out of that account. If you try to convert and then you also have to take a distribution to pay the tax on the conversion, it sets up this inefficient cycle that generally doesn't make any sense. And let me warn you of this too. The taxes on doing Roth conversions can get very expensive. So the most obvious analysis is generally centered around answering the question, will paying taxes up front reduce the overall taxes throughout retirement? Now, this is not too hard to quantify. It's pretty black and white, really. When we build these, we have to assume that taxes are going to follow the path of current law, which means that the Tax Cuts and Jobs Act is going to sunset at the end of 2025, and the tax law is going to revert back to the old system. Now, the likelihood of it happening just like that may not be all that great, but that's what we know right now. And so we have to use that, or we're just getting into predicting the future based on gut feeling, which I do think has its place, but the hard data has to be based on real facts. And, the trick to getting a Roth conversion right is finding 2 things. How much needs to be converted, and how long of a period do you need to do those conversions? Now, this can really only be tested through looking at multiple scenarios and then evaluating the results. We have to consider all of your other income sources and then build a plan that balances the tax impact now with the tax savings later. And this is the part that I think some people get screwed up on. They either only consider the tax impact it will have during the period that they are converting, or they completely ignore that and only focus on the tax impact later. And to get this right, you really have to do both. The second reason to think about a Roth conversion is that you think taxes will increase in the future. We're just a few years away from looking at the expiration of the Trump tax cuts, and at the same time, we're hearing about proposals to raise taxes. So a lot of people are starting to wonder if yet another piece of conventional wisdom in financial planning is wrong. And we've all heard this. I've heard this for a long time coming up through this industry. That's, you should put your money in pre-tax savings because when you retire, taxes should be lower. Well, maybe not. In fact, if you really look at the data, taxes right now are about as low as they've ever been. Let me show you an example. Let's first look at tax rates today. Let's assume that your adjusted gross income is about $160,000. Now, this is a fairly typical adjusted gross income for the retirement planning cases that we do, where the client says they'd like to get, $7,000 to $9,000 in net income per month. Now, let's take that same $120,000 and adjust it backwards for inflation. And we're not getting too fancy for this. We're just adjusting it based on the annual changes to inflation as measured by the Consumer Price Index. If we take that back to 1980, that's about $30,000. So a $30,000 income in 1980 is equivalent to a $120,000 income today. Now, if I stop the workshop right here, I still think this is a valuable lesson in the power of inflation and how you have to prepare for that in your retirement income planning. But today we're looking at taxes. So how would the effective tax rates have changed over that period on the same level of inflation adjusted income? Well, let's look at today first. And keep in mind, this is federal taxes only. So we're not looking at state taxes or if any of the income is coming from work. So there's no FICA taxes calculated in either. So today, if you have $120,000 in adjusted gross income, your average tax rate is about 12%. But if we time travel with that same $120,000 and adjust it for inflation, we actually find that today's tax rate is the sweetest deal that you would have gotten in the last 4 decades. For a good chunk of those years, the average tax rate would have been 18%. And again, that's for the same level of inflation adjusted income. And if we go back before 1980, the rates were even higher. And in some of those years, they were much higher. So I don't think it's beyond the scope of possibilities that we could see tax rates go back up. And right now, that's not something that's being accounted for when we do a Roth conversion analysis. And you can't, like I said a moment ago, that just gets into the crystal ball thinking and, trying to predict the future. So right now, we still have to assume that at the end of 2025, Trump tax cuts are going to sunset. The old rates are going to come back. Excuse me. But if rates get adjusted higher, tell you, that is a game changer. All right. Moving on to the third reason to think about Roth conversions, and that's you want to lower taxes to your heirs. Now, this certainly isn't everyone, and I don't encourage people to save all their money to pass it on to their heirs, because I get to see a fair number of those cases too, and I know what happens in the days after death. But, a lot of people do have that as one of their maybe secondary or tertiary retirement planning goals, is to leave some money to their kids or maybe some other heirs. So I get it. But if you have more saved than you're going to spend, a lot of times that money is in an IRA or a 401k. And even when you're going to take a distribution in retirement, there's often no way that you're going to spend that balance before you die. And a lot of times, people are perfectly fine with that because they're just going to leave it to their kids. But what a lot of people don't realize is that the rules have changed on how your kids are going to have to distribute that account. Now, in the past, they could spread it over their lifetime, but now they have to empty it out over 10 years. That means that if they have decent earnings, this is going to push them way up in the tax brackets, which ultimately means that more of your money is going to be left to Uncle Sam than you may have intended. So, for example, let's say that you're going to die with an IRA worth $1 million and your daughter or son is married and they're both working. It's certainly conceivable that they could pay 25% or more of that inherited IRA in taxes. And if that would have been in a Roth IRA, they wouldn't have had to pay any taxes. So, the question that I often ask people is this. I'll often say, would you rather pay $100,000 in taxes if it meant that your kids could avoid $300,000 in taxes? Now, obviously, the number is going to vary based on your situation, but we've seen lots of cases where that ratio holds true. So that's yet another reason to consider a conversion, even if it doesn't make sense, looking at it mathematically over your lifetime for your retirement. And one last note on Roth conversions. There really is a lot to know and think through before you pull that trigger. With the new rules, once you convert, you can't undo it. So if you do a conversion and then realize that you made a mistake, it's too late. You're going to be stuck with the consequences, whether they're good or bad. And another thing to consider is that you can't just count the tax cost when you're looking at a Roth conversion analysis. If you're 63 or older, you also have to keep in mind the impact that conversions will have on your Medicare premiums. And if you're under 65, you have to think about how that's going to affect your ACA healthcare premiums if you're on those as well. So ultimately, the discussion about a Roth conversion is one that really needs its own dedicated workshop and probably a multi-day class that, is intended to cover everything that has to be considered. There's holding periods where you have to have a certain holding period for that Roth IRA before you can start to truly realize its completely tax-free benefits. But you do need to at least get the numbers before you can make a decision, because you don't want to be 75 years old and wondering if, should I have converted to a Roth back before these required minimum distributions start? So I encourage everyone to get the data and decide then how you feel about that data and then make a decision. And this takes us to the third key factor, and that's what's the right age to file Social Security. Like a lot of the other things we've talked about, there really is no way to cover everything we need to know. We have to look at a number of different factors like the impact of survivor benefits, spousal benefits, a number of other things. In fact, I have an entire webinar that's an hour long that's devoted to this topic. And if you want to find that, you can go to devincarroll.com/SS Essentials Workshop. I know it's another very long website name, so I'll leave that up there just for a moment because I know that is a long address. Now, that webinar used to be the homepage of my website. It's not now, so people used to just be able to go to devincarroll.com and find that. But you can also find that in any of my YouTube videos. If you just look down in the description, you'll be able to find that link as well. So before we move on and we start talking about Social Security, let me tell you a few of the wrong ways to think about Social Security. And this is something that is pervasive in our industry. The tendency is there to look at the Social Security decision in isolation and not as part of the overall comprehensive retirement income plan. This is when you look at Social Security benefits and you try to solve for how can I get the most in Social Security payments over the course of my lifetime. I think that's a seriously flawed approach, and it's impossible to separate Social Security from the rest of your retirement income picture and actually make a good choice about filing for Social Security. It has to be all considered together. There's no other question, no other way to do it. Now, there are two ways that I see this mistake being made. The first is simply following conventional wisdom. Like we talked about earlier, if you can delay, you should delay, and sayings like that. That really robs you of a lot of flexibility in a retirement income plan. The other is a use of software. There's programs out there that help plan for retirement, and they are really bad about this. And, if you've ever used one, I'm sure you'll identify with this, but it seems like the answer they always produce is you should file at 70. I've often said it. It seems like that would be some of the easiest software to write. And I know nothing about writing software, but I think I could figure out how, when you hit submit, to come up with a screen that said file at 70. But that's the response that you almost always get. And I don't think that's accurate at all. I don't think that you should just use that software, look at Social Security in isolation, and then, wash your hands of that and move on to the important stuff. I think it's a short-sighted approach that is going to result in a retirement income stream that isn't nearly as efficient as it could be. So today, I want to show you a very simplified example of why integrating the filing decision into your overall retirement income plan is so important. And again, this is a very simplified plan, but it is actually a real plan that we had for a client. So I didn't just manipulate these numbers to get the results that I wanted here. This was a client and his wife that hired me not long ago. We did a retirement roadmap plan. They were planning to retire at 62. They wanted 7,000. One spouse had a benefit of around 3,000. The other spouse had a benefit of around 1,200, and those are their full retirement age benefits. They had a $400,000 joint account, that taxable account. They had in that $750,000 range in his 401k. Now, retirement was getting pretty close for them. They were both about to turn 62. They both were getting ready to retire. And something I said either in one of my videos or a podcast that we had made them want to get another opinion. Now, they'd already visited with 3 other financial planners, and all 3 of them suggested the same thing about Social Security. They said that this couple should file for benefits at 70, and between 62 when they retired and 70 when they filed for benefits, they should get their monthly income need met from their retirement savings. And the rationale behind this was that once their Social Security turned on at 70, they wouldn't have to take much from their retirement accounts, and most of their monthly needs would be met with their Social Security benefit. And in so doing, they should lower their taxes because after 70, they'd be able to get their Social Security benefit with minimal taxes. And since that advice lined up with just about everything they were reading online, they decided that filing at 70 would be the plan. But again, then they heard something I said, they stopped, they decided to reconsider and get some alternate advice. And after we chatted on the phone for a while, they decided to engage us in a retirement roadmap plan. And one of the first things that I told them was that we needed to at least look at the numbers for filing at other ages. You know, I've done enough of these plans to know that unless you test different filing strategies, you really don't know how it's going to come out. Sometimes I'll think one way and it'll even fool me. Just when I think I have something figured out about how someone should file based on simple criteria and napkin math I do in my head, we put all of the factors together and something pops out that I didn't think about. So I always test these strategies out. So in our initial consultation, though, I could tell they were both pretty dead set on filing at 70. They were very disciplined. They knew they would be able to do it. They wouldn't change their mind. And they were convinced that this was the age that would give them the best overall result. But all of that changed when I showed them 2 very simple charts. And those charts show the 2 key factors that we mentioned at the beginning of this workshop. And by now, you're probably recognizing this as a theme for testing what we do in all of these plans. We want to understand, how the different retirement scenarios will affect the taxes you pay and your account balances, which is how long your money will last. We want to keep this simple and clean here. So I'm going to take out all the filing ages that we illustrated, except for 62 and 70. And just keep in mind that whatever age they filed, the amount of net income was going to be the same. So, for example, if they filed at 62, part of their $7,000 monthly net income would come from Social Security, and part of it would come from their retirement savings. But if they delayed until 70, then, all of it would have to come from their savings up until 70. And then once Social Security kicked in, then the amount that they were taking from their retirement accounts could be reduced drastically. So let's see how this worked out. So first, look at the cumulative taxes that they paid in retirement. That blue line you can see is if they filed at 70. Now, right at first, again, very little taxes because they actually had a joint brokerage account. Now, I'll tell you, this does change if you don't have that joint account. And if all you have is an IRA, that's pre-tax, which we see a fair number of those people coming in. That's what they've saved in because they want to reduce taxes while they're working. And that absolutely changes the scope of these plans too when it's set up that way. But in this case, they pulled their money out of their taxable account. And so their taxable income was below the capital gains threshold. But then at 67 or so, that taxable account started to run dry and they had to start taking distributions from the IRA. And all the distributions coming out of an IRA are taxable. And this caused the taxes to start increasing. And then if you look at the taxes at 62, again, a common theme, when you're taking that, when you're filing earlier, that you start to see more taxable income earlier. So we built a plan here to manage the taxes, not just on the basis of how can we reduce taxes this year, but how can we reduce taxes throughout retirement? As you can see, by the time they hit 80, the tax cost for filing at 70 was running away, and it ended up costing them more than $100,000 in additional taxes over the course of their retirement. So that's part of the data that's important in making a decision, but not really conclusive enough to be the determining factor. So let's look at how their filing age would affect their overall portfolio balance. So if they file at 70, you can see that the account balance takes a big dip in those early years. Again, that's because they're taking all of their income from their savings. And then at 70, when they file for benefits, you can see that that account balance starts to recover because now those account withdrawals are smaller. And then if we move on to 62, needless to say, that's a much different experience. By the time they hit 70, there's a $355,000 difference account balance. This is simply the time value of money at work, and it really highlights that in some cases, by maximizing Social Security, you are minimizing your retirement savings. And the reverse is true as well. By minimizing your Social Security and filing early, you could be maximizing retirement savings. Now, does it always work out this way? Absolutely not. We can't assume that filing early is always going to be the most advantageous strategy. Just changing one or two assumptions could easily swing this the other way, where filing at 62 didn't make as much sense. For example, I've never thought the goal of retirement is to die rich. So I also talked to that client about increasing their retirement income. And I know that's tough sometimes when you had your head down working and saving for 40 years. When you make that switch, kind of going into phase 2 of retirement, it can be difficult to start spending the money that you have accumulated. It can be very frightening. But if they were to increase their income needs, that would likely change this comparison as well, and maybe even change up the ages where they should have filed for Social Security. The other thing that could change this would be for a client who had a pension, or maybe even a different mixture of taxable and tax-deferred accounts. Certainly if their income needs were higher, there's a few other factors that we could calculate in there. It just goes back to the thing that there is no one-size-fits-all scenarios here that we can broadly apply. But one thing is certain, and that's that the Social Security decision does have the potential to change the course of your retirement. If we look at that green line for a moment versus the blue line, which of those do you think gave more peace to the client? When they're laying in bed at night and they're seeing their account balances go down, maybe they're not worriers. Maybe it didn't bother them. But I can tell you it would bother most people, and they would be second guessing their plan. From 63 to 70, if they were retired, they'd be very busy. They would be out doing traveling and, spending more money. And that would be concerning to see your balances dropping like that. Sometimes smoothing the ride in retirement is valuable. All right. So we've talked about the most optimal withdrawal sequence, talked about Roth conversions, and we've talked about choosing the right age to file for Social Security. So let's figure out how to pull it all together into one cohesive plan, because your retirement does deserve to be well planned and thought out. You know, going back to the roadmap analogy that we used when we first started this, I'm a Google Maps person, although I use an iPhone. I do like Google Maps. I think it's more reliable. It saved me 40 minutes when I was following my wife to my daughter's college the other day. I got there 40 minutes before I was able to sit down and do some email while they were still stuck in traffic. They were using Apple Maps. So, if you're using either one of those, though, it stretches that blue line from where you are to where you're going. And based on that, you can tell how long that trip is going to take, if you need to plan to book a hotel, where you need to stop for meals, and you can even look at some alternate routes. There's going to be a lot of other little decisions to make along the way, but you can plan a lot of the big things in advance. And that's exactly what a written retirement income plan should provide. And if you're getting ready to retire, or you've just retired and you're still trying to figure some of it out and you don't have a plan, let me tell you, should. Now, for those of you who are fanatical about the DIY approach, as I know some of you are, and that's fine. I'm glad you're here tonight. I'd highly recommend my friend Stephen Chen's new retirement software. I just talked to Stephen the other day, and they are getting ready to do some pretty robust rollouts on this. And I'll tell you, for a consumer level software, this is the most in-depth analysis that you can get. Now, it's going to take some work. There's a learning curve to it. And you can't just put all of your stuff in there, hit calculate, and then look at the results. You're going to have to run multiple testing scenarios to test the different Social Security filing ages, the withdrawal sequences, and looking at the Roth conversions, and adding all of that in together cohesively to get the results. But if you have the time and the want to, that's probably the best option for a DIY approach that's out there. The Planner Plus edition is what I'd recommend. It's $120 a year, and you can use that to your heart's content for a full year. Now, you've got the DIY software, but if you want to take this up a notch, this is actually something that we can help you with. My team and I now have completed hundreds of these retirement scenarios for people that, people like you. They're looking for a step-by-step guidance to make sure they don't pay too much in taxes, and they want to be able to live the lifestyle they want to live without running the risk of running out of money. We call this our retirement roadmap plan. This is the document that's going to tell you year by year where your income is coming from, how much it's going to cost you in taxes, and what your ending balance is. Once you get this plan, you're not going to have any doubts about the sequence of distributions, Roth conversions, or the dates you need to file for Social Security. Make it very clear and easy to read. Now, when we create these plans, we do use software. In fact, we often use multiple software programs to build a single plan. We were looking at one earlier. We had some clients on the phone today from Florida, and we use 4 different pieces of software to build their plan. There's just too many moving pieces to get it right without using technology. But what we don't do is just enter your information in a program and hit print. Over the years, I've seen so many of these plans, and they're often gorgeous plans. Back to that 80-page document that I talked of at the beginning, that sometimes it'll have your name in a gold embossed letters on the front and maybe bound up. They look really nice. And then, you get inside and it also looks nice, but in its heart, it's just a bunch of fluff. That's not what you need. You need something that gives you confidence, that you can get in and understand the data crystal clear. It needs to be straightforward, that you can understand exactly what steps you're supposed to take and when you're supposed to take them. Now, I'm not here to sell you a plan today, but I do want to make you an offer. If you've been looking for the type of plan that I'm describing, I would like to invite you to book a phone call with me. There's a link on the screen right now. I'm also going to email that to you. And, this call is going to be with me, not with one of my team members. It's with me. We can only take a few of these and only on certain days of the week. But my wife looked at me like I was crazy when I told her, I've got this webinar coming up Tuesday. Next week is getting packed. So I think I'm going to open up Saturday and take calls. She said, "You're going to work on a Saturday?" I said, "Yeah, I think I am. I haven't worked on a Saturday, at least talking to people on the phone, in 15 years. But the last time we did a webinar, we had so many of these come in that, and I don't know if any of those people are on this webinar today. We had one day where we thought we really had a lot of efficiencies worked out, and that entire day was just a dumpster fire. And so I said, we're going to go back to making sure that we take enough time to talk to people and understand it. Because the truth is, this plan isn't for everyone. We want to know if it's a good fit for you. We only want to spend our time and energy in working with a client where we can add value. This is made for those people who are serious about getting it right, and they're willing to make an investment of their time and energy to give us all the information we need to help you make good decisions. And I'm gonna tell you, there's no call or no charge for the call. Not going to charge you for that. But if you decide to engage us, we do charge a planning fee. And in most cases, that planning fee is $1,500. Now, we have a range on our website, and you'll probably see that. That's another story why we have that range. But in most cases, when people come in with those 3 buckets of accounts, fairly straightforward situation, we charge $1,500. Now, one thing I can promise you is this. These are highly customized to your specific situation. They are not templated plans where we just plug your numbers in and send it back to you and say, "Here you go. Thank you for the $1,500. We recently did a time segregation study, and we found that we're spending between 15 and 20 hours on each of these plans. And a good part of that is spent, about 5 hours of that is just spent on understanding your individual objectives, financial picture. And I'll tell you, we will dig deep here. In fact, once you schedule your call, we're going to send you an email that has a form in it that's going to ask you about your financial picture. For that preliminary call, we want to keep it efficient for both of us. And so we're going to want to know about approximate savings amounts, the types of accounts you have, your income sources, the amount of monthly income you'd like to receive in retirement. And having this information before the call is really critical to making this valuable. So if you'd like to do some more due diligence, you can go to that link on the screen now. Now, I'll tell you, we're opening this up for calls. I don't typically do calls on Friday, and we're opening this Friday up. I certainly don't do calls on Saturday, and this Saturday is going to be open as well. And then we're going to have some spots available next week in between all of the other meetings that we already have scheduled. So I visited with my operations manager today, and we looked at next week, and there's actually a little bit more scheduled than I thought was already scheduled for the next week. So if you want a spot, I jump in there and grab it for Friday, Saturday, and then you can look at the spots that are available next week. So you could just go to that screen. I saw somebody in the comments ask me, "Do you have an example roadmap?" Yes, we do. If you go to that link, devincarroll.com/roadmap, they're about halfway down the page, I think. There's a video there. Now, it's 20 to 30 minutes long, so you don't have to watch the whole thing, but you can get an example of how we approach this decision. And I'd like for people to watch that, before they pay us, for sure, because I want you to understand that this is not some glossy, beautiful document that we're going to send you. This has hard data in it. So, go there, watch that video, and then judge for yourself if it's what you're looking for. One thing is for sure, I do know this. No one is going to feel the pain of retirement mistakes like you will. Your tax advisor's not, your financial advisor's not, your attorney who recommended you to someone, they're not going to feel it. It's on you to figure out how to plan your retirement on your own, or to find a guide that you have confidence in to help you create this plan. I hope I get to see your name on the schedule. And again, that's just devincarroll.com/roadmap. And now I went 6 minutes over. I tried to keep this right at an hour, but I do want to open this up to questions. So let's stay a little bit longer. So next slide says questions. Let's go to the questions. The first question I see is BB King. I went and saw BB King in concert. He came to Texarkana. It was one of the best concerts I've ever been to. There was a band that opened up for him, and they were good. They were traveling with him. They were good. But it was a whole different level when BB's band started. Anyway, BB King, you asked me, do any of your plans include life insurance strategies? So life insurance is absolutely something that we review in these plans, especially for those people who have those, laser funds or LERP plans or those, overfunded life insurance plans that at some point they expect to be able to pull out tax-free income out of the cash value. So we absolutely do look at that. Now, that adds a little bit of complexity to it because when we're getting those documents, we do have to go back to the insurer and get an in-force illustration so we can understand exactly how that's going to play out and some of the guaranteed values versus current values and things like that. Kim asked me, how much before retirement do you recommend getting a consult? Age 60? I would say this, Kim. I'm actually starting to recommend this for people who are 50 and up. I'm likely going to do a whole separate webinar just aimed at those people who are in that 50 to 5 years before retirement time frame. And here's why it's important. It's not so you can figure out exactly how you're going to strategize your retirement income. It's about figuring out what's the most efficient way to save for retirement. Something I said earlier is that a lot of people come in and they have all of their money in pre-tax accounts. And that usually just doesn't give a whole lot of flexibility. And so, if we can go through and show you how, okay, you're saving everything in pre-tax now, if we can start to defer some of that either to the Roth side or the taxable accounts, here's the kind of difference it's going to make. So, what is being considered in Washington now? This is Sharon Taylor. For Social Security, especially pertaining to, put it out here, WIP and GPO, don't know where to sign up or wait. The windfall elimination provision, the government pension offset. And, I don't know. They're talking all the time about provisions that's going to eliminate those. And I don't get too excited about those anymore. I have followed this for years and years and years. Truth is, a lot of those pieces of legislation that's talking about eliminating Social Security is actually going to replace it with an alternate formula that is, in some cases, more egregious than the windfall elimination provision. It's certainly more complex. All right. Jeff B, factor in tax on Social Security. Absolutely. Yeah, the tax component is a big part of this plan. And you're going to see that very clearly in a line item, exactly what the annual tax is. And then we also have another column where we're showing the cumulative tax. And so it's easy to tell between the two Social Security filing strategies that you may choose from, which one has a better tax advantage to it. Let's see. RMDs calculated. Absolutely. Yeah. RMDs have to be part of that. There's no question. And that that becomes part of the problem when you're doing Roth conversions, for sure, depending on the age that you want to start doing those Roth conversions, that you run up against the wall of those RMDs because that RMD can't be part of the conversion. So, depending on when you were born, your RMD is going to be most likely either 73 or if you're born in 1960 or later, 75. So Most people that come to us still have a fair amount of runway to be able to do those conversions, but absolutely, RMDs will absolutely be part of that. Bob asked, will this be available to replay? Yes, it will. Last time I did this, I did not think that it was going to be available. And then we found out later that it was available. It did get recorded. Now, I will say this may be the last one that is recorded, because starting with the next webinar that we do, we're actually using a different provider. And it's not an auto record. I think it's a separate feature and so on and so forth. So it'll purely be a live webinar with the next one. But this one, I believe, will be recorded. And I am going to try to send that out by email. All right. Roving Rogers said, do you see folks with no Roth accounts and no taxable accounts to pull the cash for the taxes from? Yeah, we do. And we have seen limited cases where that actually works. It doesn't always work, though. So I would just say that, it's one of those things that you need to get the data on and then figure it out. And going back to the data, what I often tell people is that when you're getting information on retirement planning, a retirement plan, even after we spend the 15, 20 hours on it, that's really only about 50% of what you need. The rest of it is some marination. You need to be able to look at those numbers, understand exactly how they apply to you and how that impacts the way you feel about those numbers. That's the other 50% right there. It's how you feel about the numbers. I can show the same data set to two different people and they'll have different reactions to it. I can show that mathematically something works, but they look at that and they just say, yeah, there's no way I can sleep at night if I'm paying that kind of taxes. So, get the data. Jeff B said, and life expectancy. Yeah. So Jeff, that actually raises an important point here. When we're doing these plans, there are endless assumptions that we can change. Now, we do have our defaults. For example, long-term care is part of the plan. So we take today's cost of the average long-term care, in-home long-term care. We apply the rate of inflation to that, and we say that that's going to apply in the last 2 years of plan. Some people will say, nope, don't need long-term care. A plan that we did just a couple of days ago, they have a long-term care plan, or long-term care insurance, but it's not going to pay all of it. And so we had to reduce the amount of long-term care that they're going to receive. Some people will say, Devin, I want 6 years of long-term care. All of those assumptions can absolutely be changed with no problem at all. In fact, when we're first going through getting a plan like this set up, we will often ask about those assumptions. You ask about life expectancy. That as a default, we generally use age 90. Some people will say, no, I want to use age 100. And then some people, bless their heart, they'll say something like 70. My dad died when he was 70, so I think I will too. We often will try to encourage them to push that out a little bit. But all of that is certainly stuff that we can change. We can change, what do we think inflation's going to do? We can change, what do we think taxes are going to do? We can change rates of return. All sorts of things that can be modified with plans. Let's see. Bruce said, I plan to work to 70, currently 64. Does not make any sense to get Social Security while I'm working. Yep, probably not. No, if you're working and you're over the earnings limit, I don't blame you. That I wouldn't be filing then either. That likely does not make sense. Let's see. Let's see what else we have here. Turn this off. All right. We've got a few roadmaps that have already come in. Almost feel like I'm selling something here, but I'm not. I'm telling you, there's no pitch. When we get you in here, we really just want to find out, is this appropriate for you? And if it's not, then I'm going to tell you. I've told many people that in the past, lad. really don't think you need our plan. Maybe it's because they either don't have enough and they're just not going to be able to achieve what they want to achieve, and there's no way to do that, or they have so much that it's just not going to matter. And we had a guy come in the other day with millions and wanted $5,000 a month. Why do you need a plan? Just their Social Security alone was going to cover that. So, we absolutely don't mind just telling people if they need a plan. And it's not everyone at all. Raven Rogers said, booked a call. Excellent. Thank you. Yeah, it looks like we've gotten quite a few of these that have come in. I didn't know I put the sales pitch on that hard. Maybe I did. I just picked up my phone to see, and yeah, there's a bunch of them coming in. So, Purvey, you're asking about new retirement software, I believe. Very good. And Kim, you are so welcome. Thank you for being one of the audience members, because if you weren't listening to the podcast and watching the videos, I wouldn't be able to do this. Big Kahuna said, "Hi, how are you, Big Kahuna? Hope everything is going well." Let's see. Let me scroll back through these, and then I'm going to go back and we'll see what else has been added. See, we talked about the replay. We talked about taxes on Social Security. Talked about the windfall elimination provision. How much before retirement? Somebody said having issues getting to your site. Well, I know not everyone's having that issue, but if you're having an issue getting to the site, let me know. I am going to follow this up with an email that's going to have that link in that. But yeah, be sure to let me know. And Daniel, yep, here's a good question. He said, when considering a Roth conversion, how do you determine the correct amount? It really goes back to having to look at how much static income you have. People will often come in and say, I want to do a Roth conversion, and then they'll tell me about their military pension that's $10,000 a month. It's just not leaving enough room, in the tax brackets without running them way up in there to do a Roth conversion. So it's really all relative to the amount of static income you have and how much you're willing to pay in taxes to get that done. And then we want to measure what's going to be the impact over the course of your retirement. If we're just looking at it mathematically, right? The other two reasons that we talked about, what if tax laws change, and then leaving the money to your heirs, not so much the mathematics side of it. But, for most cases we do, that's how we determine that. All right. Let's see. Erica also asked about establishing a plan given the potential that factors could change like tax rates. That's the only problem I have with planning. I tell people this sometimes, and they look at me like I'm growing a third eye. After we do these plans, I am convinced, by the way, that our plans are probably the most accurate out there. I've seen other plans, and I know what kind of knowledge and work goes into those. And I know the work that my team puts into these. But I also know that as soon as we create those and send them to you, it's a great snapshot in time, but in the future, they're going to be wrong. There's no question. Life evolves. Taxes change. Other things happen. Legislation comes out. There's all sorts of things that's going to happen. So a lot of people will ask me, okay, Devin, look, give me a plan, and then can I come back and update that plan with you? And so I often tell people that, yes, there's two ways you can engage us. You can engage us on a one-time planning basis. And again, that's generally $1,500. And you can come back next year and do the same thing. And then the next year, and then the next year. And you can get that plan updated annually if you really want a good accounting of where you stand and how you're meeting those retirement objectives. The other way is a comprehensive engagement. That's where we do all the same planning steps. This is the cornerstone of what we do for all of our comprehensive clients. But then in addition, there's the investment management, there's the rebalancing, the tax loss harvesting, all of that goes into it. So if you think about what you may be getting right now at the traditional financial advisor's office, well, if you do that plus add all the planning to it, that's the way that we approach that comprehensive relationship. So I hope that answered your question, Erica. All right. Rick Mull said, appreciate it. Have a good night. So Rick, I guess you're out. Let's see. Site came up with an error message. I couldn't get to the site. How do I get access to new retirement? I wonder if it is a bandwidth issue. I'm going to go to the site real quickly and check it out. I don't know if it had too many people trying to get on it at once. I wouldn't think so. Not with 100 and something, 200 people. Let's see. Well, I was able to get right to it. Let me see if I can post a comment. All right. For those of you who had trouble getting to the site, you might want to take a look at that link there. I don't know if it's clickable in YouTube comments or not, but I just put it in the comments. And so you may want to take a look at that. That should get you right to the site. Okay, Coach C, taking early at age 64, I would multiply by 0.8 and then multiply by 2 years projected COLA. I assume 2%. Then good grief, Coach C, I can't keep up with all that on the fly. Get a projection for 64, correct? I'd have to go back through and look at that. Yeah. Now you got me thinking though, 2%. For 64 face value, that seems right if you're trying to add that 2% cost of living adjustment in there. Yeah, because you're multiplying by 0.8, you're getting it back down. Okay, perfect. Okay, all right, White Horse, Yukon territory. Excellent. I did not know that's where Roving Rogers was. White Horse, cold place. Charlie Marlowe said the link worked. Excellent. Randy B said spelling. Do I have a spelling error on the screen? I don't know. And Mike said same question as Jeff B. Let me see if I can go back up here and see what Jeff B's question is. Do you advise on asset allocation? Oh, there it is. Man, they went by so fast. I didn't even see that, Jeff. Yes, we do for sure. Part of all of our plans is to probably not take an extremely deep dive, but there's a few things we're going to tell you. Number one, we're going to tell you if your asset allocation is out of whack. We see people come in quite often. It wasn't long ago, a guy came in and had all of his money in the ARC fund, that ARC Innovation Fund. And if, a lot of you may have heard of that back in 2020, it was a really popular fund, coming out of COVID. All of those companies that were in there just did extraordinarily well. And I can't remember how much that fund was up that year, but he decided that, hey, this lady running this hedge fund, she knows what she's doing, and I'm going to put all my money in there. That was certainly something that we had a conversation about. If we see that your expenses are out of whack, we're going to tell you that as well. We always want to do a fee analysis on that. And then we're just going to kind of tell you how we approach the asset allocation conversation. And I want to tell you, for investments, we keep it very, very, very simple. This is a whole different webinar here to talk about our investing approach. But I'm going to tell you, I'll tell you this right now, and I mean it. Investing doesn't need to be complicated. I think it was Warren Buffett that said there's a perverse human characteristic that likes to make simple things complex. And I can tell you right now that a lot of financial advisors love to make their secret sauce all about their investing approach. They'll say that we have an investment policy committee that meets weekly or quarterly or monthly, whatever it is. And, we're buying and selling, and like they have some sort of insight on what's going on in the market. No, that's nonsense. There's enough data out there now that shows beyond a doubt that the best way to invest is to simply use low cost, broad-based ETFs that mostly track an index, right? And multiple indices, hopefully, not just one index. And that's really as complicated as that piece needs to get. But a lot of advisors are unfortunately they're scared of that because if they don't have the investing secret sauce, they don't have the staff to do the planning because in many cases it's just them and maybe an assistant there. And planning is extremely consumptive of time. And so, I think it's the way of the future. I think there's enough data out there to understand that all you really need to do is have a broad-based portfolio of ETFs. And then the difficult part for financial advisors that focus on the planning, they understand that the investing compared to the planning is easy. The planning is what takes all the continued learning. It takes the constant reevaluation of multiple factors and then walking that retirement journey with you. And, when you're thinking about selling a house, buying a house, the other day, a client wanting to buy a tractor, how does that fit in my plan? And after a while, that's what works into your vocabulary is you want to figure out, well, here's something I'd like to do. I wonder how that fits into my plan. And so it gives you the ability to make data-driven decisions in retirement, and you understand how that should impact you. That's the tough part about what we do. The investing piece is relatively easy. So, Jeff, I know I went off on a tangent there, talking about the investing piece, but we do absolutely advise on that. And Kim said, "Amen to your investing advice." Well, thank you, Kim, for being in the amen corner there. I need all the amens I can get. JT said, "ETF is good advice and are typically low fee." Most of them are. Yeah, most of them are. But we're starting to see ETFs have kind of worked their way into some of the popular financial sites, and then so people are thinking, well, I think I need to buy ETFs. And so what we've started to see is that some of the actively managed mutual fund companies that have been out there with mutual funds for decades are now offering their mutual funds in an ETF format. And so people are getting this assurance that, well, I'm buying an ETF, I think I'm doing the right thing, and they're really just buying a mutual fund with new clothes on it, and that's about it. Sharon, how to come up with a good estimate cost of living for 30 years from now. That's a tough one. All we can really do is take inflation, take today's monthly net income need, and apply an annual rate of inflation to that. And I'll tell you, over a 30-year time horizon, I'll tell you what we've seen in most of these plans and what we actually end up doing in most of our plans. This is Jeff, if you're still on here, we were talking about assumptions a moment ago. This is one of the assumptions that we can absolutely change. But my preference is, and this really comes after walking the journey, over the last 20 years in this business with people all the way from the point where they retired all the way up till their death. And that is that we've seen that, the whole go-go years, the slow-go years, and the no-go years is accurate. And I've seen that happen time and time again. In those first few years, you're going to spend more because you're out doing all of the stuff that's been deferred. Travel, maybe it's fishing, golf around different places, whatever it is, right? After that, people tend to start going, okay, I'm good. I don't need to go on any more cruises, right? I've done enough. So I'm happy just staying at home. Or it could be that an illness mandates that they stay at home. Whatever the case, they generally find that they're just not getting out and about as much, and they're not spending as much money. So as part of our spending plan, what we like to estimate is that you have a 20% reduction at age 80, and then at 85, another 5% reduction to your spending. You can look back at some of the academic studies that have been out there that talk about how retirees spend their money, and you can actually find that that's what those studies have identified as well. Some people will come in and say, nope, want to leave it at 100% adjusted for inflation every year, and that's fine too. There's a number of things that you can throw into those plans. Let's see. Steven said, seeking a tool to calculate IRA withdrawals for Roth conversions. Steven, if you're wanting to calculate that on your own, try New Retirement. Buy one of their subscriptions. I don't think you can do the Roth without paying the $120. And then if you really want to get serious with it, just hire me and my team. We can help you figure out the Roth conversions. As far as the other tools, there's some of the other financial websites that'll give you a Roth conversion analysis. But it's unfortunately, generally, it's only looking at the amount of tax that you're going to pay on that conversion. And it doesn't look at all your other sources of income. And that's a tough one. You have to be able to look at that to really know how much tax you're going to pay. Instead of just plugging in this arbitrary effective tax rate, well, I think I'm in the 15% tax rate. It also doesn't count for the income-related monthly adjustment amount with Medicare or any of that. Okay, let's see. Kelly, you said it worked for you? Good. Glad. Using Chrome. It's because you're using Chrome. I wish more people would use Chrome. A lot of these websites now are built for Chrome users, and if you're using a Safari, and I don't even know what some of the others are out there, it's just not as efficient. Bob, how close does the Social Security COLA come to actually covering what the true inflation number is for a senior? It's hard to say. Let me say this. For years, there has been this push to change the cost of living adjustment over to the CPI-E. Right now, it's based on the CPI-W. So the CPI-E is an experimental index that the Bureau of Labor Statistics runs that is supposed to be geared towards the elderly. Now, there were some times when that index was higher than the CPI-E, and man, it really got loud then. Everyone started screaming about, we need to change to the CPI-E. But over the last couple of years, as inflation has picked up, if they would have changed to the CPI-E, those cost of living adjustments would not have been as large. And so you don't hear a lot of people talking about that now. But then we could still make the whole argument about, okay, so how does the CPI-E actually compare to the real inflation? And that's a hard one because everyone experiences inflation differently. Back when eggs were so hot, depends on how many eggs you ate, right? Those kind of decisions. So it's really hard. That CPI is just a basket of goods that they take the prices on, and they go out and they do these surveys and they get those prices and combine it in there. And there's a whole lot of factors that are in that CPI. And it's supposed to be, as accurate as you can get. There's some pieces of it that I don't really like how they do, like housing, but, I guess it's good. Coach said he's listened to Big Picture Retirement for years now. Well, thank you, Coach. We're back. And, for those of you who haven't listened to Big Picture Retirement, you need to find it. If you have an iPhone, you already have the podcast app on there. Go there and search Big Picture Retirement. And it's the one with the green. There's a couple of other yahoos out there that are now calling their podcast Big Picture Retirement. And I think they didn't listen to my podcast knowing that my co-host is an attorney. And, don't infringe on the intellectual property of an attorney. So, you know what they say, mess around and you'll find out. So what percentage are you including for investment growth? And then Lee, I think I saw you ask that a moment ago, so I do want to get to that. And let me go back to B. Thomas real quick. What percentage are you calculating in your plan for investment growth? So there's two ways that we look at investments here. The first is through the very traditional Monte Carlo simulation, right? Where we go back and we take 1,000 iterations of randomized market returns based on your asset allocation, or at least the asset allocation that we think you should use. If you come in and yours is kind of screwy, we're going to say, hey, you need to fix this. But based on your asset allocation and based on your withdrawal needs, we're going to look at 1,000 different market iterations. And we're going to say, okay, how would your income, have lasted throughout the course of your retirement if we just randomized all the market returns. That's a Monte Carlo simulation, right? And we want to have a probability of success that's somewhere around 75, 80%. Now, that's a very first line fundamental test. In the actual cash flow section, which is where we spend most of the time focusing, we generally use a 5% net rate of return. And I'll tell you why. A lot of people will look at that and say, "But Devin, I've been getting 12%, and right. I mean, the S&P 500 this year is up 15. So, for us to use 5, I get it. It seems low. But the reason we do that is that sequence of returns risk that's there. When we're using linear returns, we really have to discount those to try to mitigate the potential for a sequence of returns that could be negative. And we don't want to get into a situation where, the market's down 20%. We've calculated for you to earn 10% and you're not getting that. When you're in the accumulation phase, saving, sequence of returns really doesn't matter that much. When you go into the decumulation or the spending phase of retirement, then it absolutely matters. I would encourage you to use a lower rate of return. And I'll tell you where we get our rates of return is the JP Morgan forward-looking capital market assumptions. That's what we use for the Monte Carlo. And then on the cash flow, we subtract 2 percentage points plus another, and that's just for market volatility, and then another percentage points for an average advisory fee. And that's what gets you down to that 5%. Lee, does your roadmap cover Medicare decisions? So yes and no. We certainly cover in there. You're going to see a separate line item that's going to have your healthcare cost. It's going to show, whether you went with the Medicare Advantage, you went with the Medicare Part B and D, the kind of traditional Medicare. We're going to show that as a cost. But as far as advising you on Medicare, no. That is something that I generally leave to my friends over at Boomer Benefits. I don't understand it anywhere close to what they do. So I would advise you to get in touch with them for a Medicare decision, so, which plan should you sign up for? Honestly, I'd be lost if it got to that. And then after receiving the roadmap, can we update it continuously for changes? Yes and no. You can. Here's the problem, though. When we show you this, we're going to export it, and we're going to take all of these different pieces of software. We're going to export the results onto Excel. Now, because it's an export to Excel, it's not going to have any of the live formulas in it. So, just changing a set of assumptions in one column isn't going to flow through and change everything else. We would have to change that in our software and then export it back to do that. So I think that's what you're asking. If you're asking, can you update it? The answer is probably no. If you're asking, can we update it? The answer is yes, we can. Now, we would recommend updating it every year. And so when you come back and you want to re-engage us, it's generally the same fee because we're going to go back through all the same information gathering steps, re-verifying everything, relearning that client picture. And we do save all of these in our secure portal. So we're going to know, a lot of it, and that'll make us more efficient, but we can absolutely go back and help you with that. Gus said, will this webinar be available later on YouTube? Not on YouTube for the public consumption, but I am going to have a video link to this that I'll send out a little bit later. Well, guys, thank you all so much for spending an hour and 40 minutes of your Tuesday evening with me. I really do appreciate it. And just looking at the number of calls that have already come through, looks like I'm going to get to talk to some of you in person too. Well, not in person, but over the phone personally. Anyway, I hope you guys have a great rest of the evening. And stay tuned. I'm going to do another one of these webinars. So if you like what you heard and you want your friend, you want your family members to hear it, be sure and pass it along. All right. Take care. Bye-bye.